the deal that centralized credit. It was framed as cooperation, described as coordination, and justified as efficiency. But this single agreement quietly pulled credit toward the center of the American banking system. And once credit centralized, power followed in ways few fully understood at the time. To understand why credit today feels concentrated, distant, and systemically sensitive, we need to return to a moment when decentralization was traded for stability, a moment when decision-makers believed alignment would reduce risk. Because that same logic continues to shape banking outcomes today. For much of American history, credit was fragmented by design. Banks operated within limited regions. Lending decisions reflected local conditions, industries, and cycles. No single institution could dominate the flow of capital nationwide. This fragmentation created inefficiency. Rates varied, access differed, capital moved unevenly, but it also created insulation. When one region struggled, others absorbed the shock. Credit tightened locally, not nationally. Failure remained contained within geography and context. Over time, this structure came under pressure. Large institutions argued that fragmentation restricted growth. National businesses needed national banking relationships. Uniform credit standards promised smoother expansion. The proposed solution was coordination, shared frameworks, aligned practices, centralized clearing and settlement, a deal that would harmonize how credit flowed across institutions. At first, the benefits were undeniable. Transactions accelerated, costs declined, capital moved more freely, liquidity appeared deeper and more reliable, banks gained access to broader funding sources, borrowers enjoyed consistency, markets rewarded scale and integration. The system felt modernized, but something fundamental shifted beneath the surface. Credit decisions began responding less to local judgment and more to centralized standards and shared risk assessments. Context started giving way to conformity. The deal did not remove regional banks. It repositioned them. Their roles shifted from independent decision-makers to participants in a broader credit mechanism. As alignment increased, discretion narrowed. Credit became standardized. Risk pricing flattened. Differences between regions blurred. This created the appearance of balance. But balance was no longer organic. It was engineered. And once credit depends on coordination rather than diversity, disturbance no longer stays local. It travels along the same channels that once promised stability. That was the quiet cost of the deal, and it would only become visible under stress. As centralized credit structures took hold, the system began behaving in ways that felt smoother on the surface but more rigid underneath. What once adjusted organically through countless independent decisions now moved through coordinated channels shaped by shared assumptions. Flexibility declined even as efficiency appeared to improve. Banks increasingly relied on common funding mechanisms. Liquidity pooled rather than dispersed. Risk was evaluated through standardized frameworks designed to work at scale. Local variation mattered less than system-wide consistency. This changed how credit responded to early signs of stress. Instead of tightening in one region while remaining open in another, credit conditions began shifting simultaneously across markets. What was meant to equalize access quietly synchronized outcomes. Inside institutions, decision-making narrowed. Credit committees followed centralized guidance. Deviation required justification. Alignment became safer than judgment. Regional knowledge still existed, but it carried less authority. When local conditions conflicted with national indicators usually won. Credit decisions followed averages, not anomalies. The system rewarded this behavior. Aligned institutions gained easier access to liquidity. Standardized portfolios attracted favorable treatment. Deviation introduced friction few were willing to accept. Over time, balance sheets began to resemble one another. Exposure clustered around the same asset classes. Timing aligned across lending cycles. Credit expansion and contraction lost their regional rhythm. From a distance, this looked like progress. Volatility declined. Credit spreads narrowed. Capital flowed predictably, but predictability came at a cost. The system lost its shock absorbers. Differences that once slowed contagion were compressed. Adjustment became binary rather than gradual. When conditions changed, there was little room to maneuver. Credit did not retreat cautiously. It pulled back abruptly. Access tightened everywhere at once. This was the early tension forming beneath coordination. Centralization reduced friction during calm periods, but it amplified pressure during transition. The system was no longer flexible enough to bend easily. What had been sold as cooperation was quietly becoming dependency, and dependency would soon demand consequences. The conflict became unavoidable when a localized disturbance tried to move through a system that no longer allowed local adjustment. What once would have been absorbed through regional differences now collided with uniform responses. Instead of cushioning the shock, coordination transmitted it. Credit conditions tightened almost everywhere at the same time. Lenders reacted to shared indicators rather than specific exposures. Caution became synchronized, and synchronization turned restraint into pressure. Banks faced an uncomfortable choice: follow centralized guidance and restrict credit broadly, or trust local signals and risk standing alone. Few institutions were willing to deviate. Those that hesitated felt the consequences quickly. Liquidity access became more expensive. Counterparties grew cautious. Alignment proved safer than accuracy. As pressure intensified, the system revealed its rigidity. Credit did not reprice smoothly. It snapped. Projects stalled. Borrowers lost access abruptly. This sudden contraction amplified fear. Businesses interpreted tightening as systemic trouble. Households delayed spending. Confidence weakened faster than fundamentals justified. Policymakers stepped in to restore flow. Facilities expanded. Assurances multiplied. Central support replaced decentralized judgment, but intervention reinforced a structure that caused attention. Credit now depended on reassurance from the center. Local discretion mattered even less. Dependency deepened. Banks adjusted behavior accordingly. They planned around access to centralized support. Risk management incorporated expected intervention. Caution shifted from individual exposure to system positioning. The system still functioned, but only under constant coordination. Independent correction faded. Flexibility was replaced by control. This was the core conflict. Centralization reduced uncertainty during calm periods, but magnified disruption during change. The system could not recalibrate gradually. It required direction. Once credit behaves this way, disturbance no longer tests individual banks. It tests the entire structure, and the structure now carried the full weight of adjustment. The climax arrived when the system revealed its final trade-off. Credit had become reliable only when the center held. Stability no longer emerged from countless independent decisions. It depended on coordination being maintained at all times. What once looked like balance was exposed as dependence. When credit flowed smoothly, the structure felt strong. But when conditions shifted, flexibility vanished. Adjustment required instruction rather than response. The deal had achieved exactly what it promised: uniformity, efficiency, predictability. But it had quietly removed the system's ability to self-correct. Local judgment no longer slowed excess. Regional restraint no longer softened downturns. Credit expanded and contracted as a single body. Strength and weakness moved together. This changed the meaning of resilience. Survival was no longer about managing risk well. It was about remaining aligned, about staying connected to centralized liquidity, about being positioned where support would arrive first. The resolution is not a rejection of coordination. Some level of centralization is unavoidable in modern banking. But when coordination replaces diversity entirely, the system trades adaptability for control. American banking still lives inside that choice. Credit remains concentrated, decisions remain synchronized, and flexibility remains limited during transition. The question now is not whether centralization works. It is whether a system built on alignment can withstand moments that demand divergence. So what do you think? Does stability still come from the center, or from allowing risk to spread before it breaks? The